Hello students, today we are going to discuss about a technique of costing, one of the technique of costing which is there in your unit 10 as marginal costing. One of the technique which we discussed under intro part of costing. Marginal costing, margin, that is clearly mentions as according to the production, how many units will produce, as many required, that is sufficient. If we produce more than that, is nothing but more than the margin we are producing it. So, the change in total production cost that comes from making or producing one additional unit. That additional unit makes the changes in the cost of production. So, marginal costing is an analytical study of the behavior of overheads in relation to changes in volume of output, reveals that there are some items of cost which tend to vary directly with the volume of output. The essence of marginal costing technique lies in considering fixed cost on the whole as a separate, quite distinct from variable costs which only are relevant to current operations. Means the marginal costing technique says fixed costs are incurred forever whenever you are utilizing for producing the product as machines or not, like you are paying the rent of the factory where you are kept the machines for using it. Similarly, the insurance which you will pay for machineries which is based on the life of the machinery. Without paying the insurance, without paying the salary to the workers working, which is not based on the manufacturing process, which are maintenance of the machineries which are required, which are fixed. Only variable costs which only are the relevant for current operations. What are variable costs? That is vary according to our production. So, in economics, the marginal cost is the change in the total production cost that comes from making or producing one additional unit. To calculate marginal cost, divide the change in production cost by the change in quantity. That means, how many extra costs incurred, that is divided by how many extra units produced. So, the purpose of analyzing marginal cost is to determine at what point an organization can achieve economies of scales to optimize production and overall operations. If the marginal cost of producing one additional unit is lower than the per unit piece, the producer has the potential to gain a profit. I repeat, one additional unit whatever we are producing, that unit price makes a producer to get the gain on a potential profit. So, the technique of marginal costing is based on the distinction between product cost and the period cost. That is the product cost and the period cost. Why we are saying? Because the marginal cost is an additional cost incurred to produce an additional number of units. So, the main characteristics of marginal costing are: 1. It is a technique of analysis and presentation of costs which helps the management in taking managerial decisions, and all elements of costs are analyzed into fixed and variable, and the variable costs, that is a marginal cost, are regarded as the cost of the products, because as we discussed, fixed costs are fixed forever, where the extra expenses incurred is only the variable expenses. That variable cost only is the cost of products, we can say, where fixed costs are treated as a period cost and are charged to profit and loss account for the period for which they are incurred. Because according to the time, according to the period, the expenditure which are incurred, whether you produce it or not. As we discussed just now, as the salary given to the worker to maintain the machinery, or an insurance which we are paying to keep the machinery for the long life. Like that, the expenses which are fixed are the period costs which are paid or spent according to the time or according to the period. So, the product costs are the variable costs, period costs are nothing but the fixed costs. The stock of finished goods and the work in progress are valued at marginal costs only. So, the prices are determined on the basis of marginal cost. That means, the price of the product is depends upon the expenses incurred which are particularly on variable, that is particularly on raw material or a labor or any other expenses which are incurred to produce the product. So, all those prices which determines the marginal cost of the product. So, assumptions while making on a marginal cost or a costing method are all elements of cost, that is production, administration and selling and distribution can be segregated into fixed and variable components. Variable costs remain constant per unit of output irrespective of the level of output, where the selling price per unit remains unchanged, where fixed costs remain unchanged or a constant for the entire volume of production. That means, the selling price remains unchanged in the market, fixed costs are unchanged according to the total production, only the changes incurred is variable costs which are constant per unit, not for the total production. So, the volume of production or output is the only factor which influences the cost of the product, which means it gives you actual cost of product is marginal cost only, which is nothing but variable cost, which is nothing but product costs. So, marginal cost represents the amount of any given volume of output by which aggregate costs are changed if the volume of output is increased by 1 unit. It is the technique where marginal cost is not a particular system of costing, but it is a particular technique which is used for some production companies for finding out how much of the excess expenditure incurred to produce excess number of units. So, the term marginal costing is also referred to as variable costing or a direct costing or differential costing or incremental costing, which gives you a synonyms of variability. So, the cost which incurs for product is marginal cost only, which differs according to the production. So, the stock of finished goods and work in process are valued at marginal cost only. That is what it says, as whenever the product is produced, the extra expenses whatever incurred are the marginal cost, that only calculated and that only gives us the total product cost, which fixed costs are at any cost that is included. Only the extra expenses whatever incurred are added to the product cost. So, the marginal cost is the cost to produce one additional unit of production. It is an important concept in cost accounting, as marginal cost helps determine the most efficient level of production for a manufacturing process. It is calculated by determining what expenses are incurred which only one additional unit is manufactured. If you go in depth, marginal cost is an economics and managerial accounting concept and more often used among manufacturers as a means of isolating an optimum production level. What is optimum is nothing but a best possible level of production. So, manufacturers often examine the cost of adding one more unit to their production schedules. So, one more unit, how much is the extra expenses? That additional cost is marginal cost. So, at a certain level of production, the benefit of producing one additional unit and generating revenue from that item will bring the overall cost of producing the product line down. So, the key to optimizing manufacturing cost is to find that point or level as quickly as possible. So, marginal cost includes all that costs that vary with the level of production. For example, if a company needs to build an entirely new factory in order to produce more goods, the cost of building the factory is a marginal cost. And the amount of marginal cost varies according to the volume of goods being produced. So, marginal costing is an important factor in economic theory, because a company that is looking to maximize its profit will produce up to the point where marginal cost equals marginal revenue. Beyond that point, the cost of producing an additional unit will exceed the revenue generation. So, marginal cost is one of the techniques used by every manufacturing companies to produce an extra units, how much of the extra expenditure incurred, or the total product cost can be said as the cost incurred to produce a particular product is the variable cost, which is nothing but a marginal cost. The features of marginal costing: the costs are separated into the fixed and variable elements, and semi-variable costs are also differentiated likewise. Only the variable costs are taken into account for computing the value of stocks of work in progress and finished products. That is only the variable expenses. Why not fixed costs? Because fixed costs are charged off to revenue wholly during the period in which they are incurred and are not taken into account for valuing the product costs or inventories, because it incurs at any cost whether you produce it or sitting on idle. Even if you are sitting on idle, the expenditure incurs are fixed costs. The prices may be based on marginal costs and contribution, but is normal circumstances prices would cover costs in total. It combines the techniques of cost recording and cost reporting. So, the responsibility of the management is to think of the expenses incurred to produce a product is the marginal cost. The unit cost of a product means the average variable cost of manufacturing the product, and the profitability of departments or products is determined in terms of marginal contribution. That is, the contribution nothing but the expenses incurred to sell the product or to produce the product wholly is marginal cost, which is nothing but a variable cost. What are the benefits of marginal costing methods or techniques? One, it also essential in knowing when it is no longer profitable to manufacturing additional goods. When marginal cost exceeds marginal revenue, then it is no longer financially profitable for a company to make that additional unit, as the cost for that single quantity exceeds the revenue it will collect from it. So, using this information, a company can decide whether it is worth investing in additional capital or not. If they are getting the losses, obviously no manufacturing company will invest additional for additional number of units. So, marginal cost is also beneficial in helping a company take on additional or custom orders. Like, consider a company that sells a goods for $50, it has additional capacity to manufacture more goods and is approached with an offer to buy 1000 units for $40 each. So, marginal cost is one component needed in analyzing whether it makes sense for the company to accept this order at a special price. So, what to say, whether to buy it or produce it. At that situation also, management it helps a lot as marginal cost whether to spend the money or not, whether to produce the product or not, whether to make it or buy it from the market, because the expenditure which are incurred is fixed expenses if you won't manufacture, only the expenses incurred to buy it. So, fixed cost plus buying cost will make a total cost when you buy from the outsiders and supplying to the distributor in the market. So, marginal cost and marginal revenue for various product lines, it can concentrate resources towards items where the difference in the greatest. Instead of investing in minimally successful goods, it can focus on making individual units that maximizes returns. So, marginal cost and marginal revenue, we need to see regularly whether it exceeds or not. If marginal cost exceeds the marginal revenue, there is no use of spending the money to produce the product. There the management can take the decision to produce the product or not. Why is marginal cost important? As we discussed, is an economic concept that plays an important role in the business management, since it can help businesses optimize their production levels. It refers to the incremental cost of adding one more unit of production, such as producing one more product or delivering one more service to customers. So, it is generally associated with the manufacturing businesses, although the concept can be applied to other type of businesses as well. So, marginal costing technique is very much necessary for manufacturing companies. What is the difference between a marginal cost and average cost? Some may have a doubt, because marginal cost, some people assume that it is an average cost or more cost which is incurred more than the average. So, average cost is different, marginal cost is different. Marginal cost is the expenses needed to manufacture one incremental good, means one additional good. As a manufacturing process becomes more efficient or economies of scales are recognized, when the marginal cost often declines over time. So, there is often a point in time where it may become incrementally more expensive to produce one additional unit, whereas average cost is the total cost of manufacturing divided by the total number of units produced. So, the average cost may be different from marginal cost, as marginal cost is often not consistent for one unit to the next, where marginal cost is reflective of only one unit, while average cost often reflects all units produced. So, there is a lot of difference between marginal cost and average cost. So, average cost is nothing but the total cost, where marginal cost is an additional cost or extra cost incurred to produce extra units. So, formula for marginal cost, if you go, a marginal cost equation is there by which we can identify. So, marginal cost is calculated by dividing the change in cost by the change in quantity. That a factory is currently producing 5,000 units and wishes to increase its production to 10,000 units. So, if the factory's current cost of production is $1 lakh, and if the increasing their production level would raise their cost to $1,50,000, then the marginal cost of production is $10, because the excess number of units with the excess cost, means the additional cost how much is incurred. If you subtract 1,50,000 to 1 lakh, the difference is your 50,000, and the different number of units, that is 10,000 to 5,000, the additional units you are producing is 5,000 units, the extra expenses incurred is 50,000. So, the marginal cost is 50,000 by 5,000 is $10 per unit. Like this, we can identify and we can calculate the marginal cost. That means the additional cost incurred to produce additional number of units, and there is a lot of difference between marginal costing and absorption costing. That is also very important. It is there in our syllabus. And what is marginal costing we discussed, but what is absorption costing, it makes a lot of changes. So, marginal costing, costs are classified as a fixed and the variable, while direct costs are mostly variable costs and indirect costs, that is overheads, may be a semi variable. So, the variable portion is the total overhead costs is identified, and thus the total variable costs are computed. Only variable costs are charged to the product, while the fixed costs are not absorbed in the product units. That is under marginal costing. Whereas absorption costing, costs are classified as a direct and indirect costs. Direct costs are identifiable with the particular product and hence charged directly. Indirect costs, that is overheads, and are first identified apportioned to the cost centers and finally absorbed in the product line or product units on some suitable basis. So, what is the difference in these two things? Marginal cost is the variable costs only, whereas absorption cost is the total cost which incurs as a fixed or a variable. Under the marginal cost, if you go, the year end inventory is valued at variable cost only. Fixed costs are not taken into consideration while valuing the inventory, as they are not observed in the product lines. Whereas absorption costing, the year end inventory of finished goods under absorption costing is valued at a total cost, that is fixed and variable both are considered. If you go to the another difference, the fixed overheads are charged directly to the costing profit and loss account and not absorbed in the product units. Therefore, there is no question of under or over absorption of overheads. Whereas absorption costing, the fixed overheads are absorbed may create some problems like over or under absorption. This happens because of the overhead absorption rate which is predetermined. So, fixed costs are not taken into consideration while valuing the inventory, and hence there is no distortion of profit. Whereas in the absorption costing, due to the inventory valuation which is done at a full cost, that is the cost related to current period or carried forward to the subsequent period, this will distort the cost of production. So, absorption costing and marginal costing both are looking similar but not same. So, absorption costing we can say it as an average costing also, because in the average we will take total fixed cost and total variable cost, combinedly cost are total cost. So, in this marginal cost we have a techniques to find out how much profit we are getting, whether we will be getting a profit or not. If we want a particular profit on a particular number of units, how many units to be produced and how much of the profit we may get it, that can be calculated, and that technique is a mathematical technique which is applied here in the form of a formulas. First, we can discuss about the contribution. Contribution is the difference between sales and variable costs or a marginal cost of sales. That is, sales minus variable cost is your contribution. It may also be defined as the excess of selling price over variable cost per unit. That is, selling price per unit minus variable cost per unit can also be said as contribution per unit of product, where variable costs only are matched with the revenues under different conditions of production and sales to compute what is known as contribution towards recovery of fixed costs and yielding of profit. So, the contribution is equals to sales minus variable costs or contribution equals to fixed cost plus profit. Why? Because marginal cost equation gives clearly that sales minus variable cost is the contribution, or sales equals to variable cost plus contribution, or sales equals to variable cost plus fixed cost plus profit. The totally we can say as sales of the product. So, do remember these formulas are very much useful to find out whether we are getting a profit or loss in our business, whether to produce the product or not also in the business. That estimation can be done it easily by means of these formulas. And in the marginal costing technique only, we have a break even analysis. In depth, we are going to discuss again in the other class, but a formula makes a difference. So, what is a break even analysis? Break even analysis where there is no profit, no loss position. Means in the business we may not be getting a profit, neither loss. So, BEP in units, if you want to find out, there is a formula as fixed cost by selling price per unit minus variable cost per unit. Shortly we can write as FC by selling price minus variable cost per. So, BEP in sales volume, that is in the sales value, if you want, then fixed cost by sales minus variable cost into sales we can apply and we can find out. And all these formulas we will discuss in detail under break even analysis, where another class in which we can discuss in detail and we can do some numericals also. With this, we can conclude that what is marginal cost and what is a marginal costing technique, when we can apply this technique so that we can get the profit in our business or not. That estimation part also can be done it easily in this type of businesses. So, all manufacturing concerns will apply these techniques to find out whether to invest, whether to produce additional units or additional cost or not. At that point of time, this marginal costing technique is applied. With this, we can conclude that we discussed one of the technique under costing methods.